Hey, what's happening, guys? Welcome to the Collective Mindset Podcast. My name's Jordan. This is my compadre.
I am Gavin Guthrie. Good to be here.
We're ready to rock and roll today.
Yeah.
We wanted to piggyback and talk a little bit more on our previous episode and where we discussed whether or not a crash was coming. Link in the description there if you didn't get a chance to catch that. Slightly controversial take depending on the circles you run in. But we wanted to kind of dive into that a little bit more, some of the feedback we received, some of the continued dialogue that we're having in regards to the current real estate market, what's happening with mortgage rates, the Fed, and all of this craziness.
Yeah. I think you and I have felt it, right? There's a lot of people, a lot of differing opinions on all of this. But I think the one thing we all agree on is these are really weird. The conditions going on in the economy and just in the general real estate market are very strange. This is just uncharted territory for most of us. I don't think anyone's really seen a situation like this where we've got super high inflation. Everyone's housing payments are kind of just on the way up and up and up as far as rents and new home buyers. And we've got persistent inflation and we've got higher rates. We've just got a lot of pain going on. And I feel like the market's kind of got us prepared or feeling like, hey, this is the new norm. And I think you and I might be feeling this and maybe others when they're talking about this crash is coming, right? Like we're all kind of waiting for the shoe to drop. Mm-hmm. And what does that look like? Or, you know, how does that impact the real estate market? How does that impact potential homeowners and just the families that we know and our families, right? How does it impact us? So, you know, we've got some stats here, a little bit about what the market's doing in general, but we really just wanted to kind of get into the nitty gritty and have a little bit of a combo.
Yeah. I think the interesting thing, what you're touching on there, Gav, is about, you know, all of the, how confused all of the experts are in this process. So yeah. I would obviously I'm going to call myself an expert, because I've just been involved in real estate and mortgage finance for over 20 years. And so I wrote loans in the early 2000s. I watched the housing crisis unfold in 2006, 7, 8, and then the disaster that then ensued in 9, 10, 11. I mean, it's like I've been there, I've seen it, I have discussions all the time, and there's so many things that are different than there were last time. It's not so simple as, oh, well, there were, you know, pay option arm loans or stated income. It's more so than that, you know. But this time, why we say this time is different is because it is different. It doesn't mean that there's no crash, that the crash couldn't come, because there very well could be a crash that comes, but it also could be isolated to specific populations. It could be, you know,
industry specific.
Industry specific, yeah.
A stock market crash isn't the same thing as a real estate crash. So what if we do this? So what are the different, like we talked a lot about a black swan event last time, right? Like a black swan event, something just kind of unaccounted for that would cause, that is outside of the data that we have right now, right? Because the data we have right now is that there's super limited supply. A lot of people don't want to sell. You know, the supply and demand balance is out of whack. All those things point to no crash. But the black swan events, we keep talking about it. So what are some things that would be a black swan event in your mind, Jordan?
Well, I mean, first off, any kind of like natural disaster of a significant nature, right? Like if there was major earthquake or just crazy hurricane, that kind of stuff.
Terrorist attack or something.
Terrorist attack. There's a lot of talk. I mean, we can't ignore the fact that there's a part of the world that's at war, and there's other, you know, China and Russia have both, like, they've got to look at the weakness of America right now. And, you know, if you have a grand plan, then you want to attack America, like, probably could be a good time. Never been a better time than now. So, I mean, there's those kind of things I would say are a black swan. You also have, obviously, like if another pandemic came, something else that caused like unemployment to absolutely skyrocket or spike. Now, we also, so it's this kind of this idea in my mind that the Fed and most economists and banks are kind of playing this game of financial chicken. And the Fed for sure is, because they're just like, okay, how much more, like, instead of how much more air can I put in this balloon, it's kind of the same thing. It's like, how much more can I pump these rates and keep this balloon nice and flat so it presses everything else down without it popping and exploding.
Blowing it up. Yeah.
Right? That's what it feels like. And if you listen to any bank CEO, like listen to Jamie Dimon, who is the CEO of Chase Bank, and he's out there and he's like, duh, like kind of sounding the alarm bells for all of his investors and people.
Yeah.
Because these policies, if we maintain course where we're at, there's a good chance there's financial Armageddon on the other side.
Yeah. Well, I think a lot of them, they keep commenting, and maybe it's because they're big public figures, right? They can't speculate. They can a little bit, but they're
very vague
can't.
with their
they
description.
They have to stay vague, and they kind of like anything that they are speculating on, they usually need to point to data that tells them why they're, tells them or justifies why they're saying this. In my mind, right, like it's what they're not saying is probably what is going to happen, right? Like they're all going to be wrong, and they're all publicly they'll be wrong. They'll probably be right behind the scenes. They'll know what's coming, but publicly they might be wrong. But the things I keep running through my head is, okay, these black swan events that could happen, what do they look like? And then how does it play out from there, right? Like play each one of those tapes to the end, right? So a big natural disaster, right? The whole West Coast gets hit by a tsunami, something crazy, like hurricane, just something massive to that extent, right? That could be something. A terrorist attack, something like that. Are we going to be looking at massive job loss where the unemployment number goes way up?
That's what a lot of these guys are saying, though. They're like, oh, this crash is coming. So you listen to people say there's a crash, and they go, well, there's a crash because there's a recession coming, which, okay, I can kind of believe that. But the only way the crash comes is if job losses are tremendous.
Yeah.
Like I even think right now, if you go from a 3.5 to a 4.5, maybe even a 5% unemployment, I don't think that triggers a housing crisis.
Yeah, I think, and maybe it depends on what industries, what sectors, experience the biggest job loss, right? Because COVID happened, unemployment numbers went to the moon, but it was like the people who probably were least likely to own homes was losing their job. So that really didn't impact real estate in that way. Whereas especially if you go market by market, right? If we have a serious tech slowdown, San Francisco is going to get destroyed. Their market's going to get wrecked. If we have a serious Wall Street
banking
crisis, right? New York might get crushed. So it might depend on what.
Hopefully, there's a political crisis and a government shutdown, and DC gets crushed. DC.
Right? So that's kind of what I keep playing out in my head, right? Is what is the precipitating event that kicks it all off? Because I do think there's probably some sort of there's definitely some repercussions to what we've been doing. The interest rate hikes, what the Fed has done, just the pumping the economy full of money like no other, and now trying to suck it all out.
Yeah.
There's going to be the economy's going to buck and haw and just it's going to hate it. And so eventually something breaks, and what starts it and what's the cascade of events that follow, right? Because we had a stock market crash in 2008. Or was it 2008, 2007, 8?
October 2008.
Yeah, it happened before the real estate really crashed. And so what happens on our end, right? Is it a stock market crash that causes a banking collapse, or the other way around, right? A banking collapse or a banking crisis with the way treasuries and bonds are? More banks collapse, and that triggers something in the stock market, and that triggers layoffs in tech. And where does that all play out? That's kind of what I keep playing out in my head. And I don't know. Do you think we can have a stock market crash without ultimately a real estate crash?
I do. I think what could trigger the stock market crash, though, is going to be the challenge that's going to come about by the commercial real estate And so that's a lot of times if you're listening to national people and they're talking about this real estate crisis, right now, if there was an asterisk there, they're probably more talking about a commercial real estate crisis because of the commercial mortgage-backed securities that are all going to roll over.
Yeah.
And the reason why that's important to understand is because most of those are on an ARM or an adjustable rate or a period of time. So 3, 5, 7 years. And if those loans were written in 2000 on a 3-year note, well, guess what? That note is maturing now. And so a majority, I don't know what the percentage is. I don't know the data. I know it's a significantly high number. Like 90% of the mortgages are on 30-year fixed rate mortgages at, say, 3.5%. So the residential housing market is insulated to a certain degree from that kind of a data point.
Yeah. I just wonder, the soft landing everyone's talking about. In my head, I feel like they're talking about the stock market.
They are the
right?
stock market,
They're talking about can the market weather this? Is without the Dow having some 20% correction, and I feel like Wall Street. They're basically just sitting around trying to wait out the next guy, right? So it's almost like they're trying to. Can Wall Street just stay afloat long enough for a real estate crash to happen so that they can still be in the money and buy it up? Or, you know what I mean? Like, or can commercial real estate crash first so that they can still be in the money and buy it up? Like, that's what they're probably hoping for. And I think there's so much money and so many influential people that work in that realm that's probably what's kept things going thus far.
Can I talk about a couple of things? I want to talk about
Yeah.
things specific to residential mortgage real estate in a crash or no crash.
Yeah.
And this is why I'm fairly convinced that there's not a crash. Could there be a pullback and a slight dip in prices? I believe that's possible. So, but I'm talking a crash of like 30%.
Yeah.
And here's why. Majority of people have super low rates on their mortgage. Majority of the people have a massive cushion. Like the average homeowner in America has a $200,000 or more cushion, which is absolutely significant. So that's probably greater than 30%. So I don't see where a distressed sell comes from. Now, then the second part about that, even if people lose their jobs and you've got a $2,000 a month mortgage payment, the average rent right now is $2,500 a month. So why are you going to fire sell your house, which is what happens in a distressed market? You take way less than you want to then go move somewhere else and pay more. That logic doesn't make sense.
Yeah.
So let's back it up. It's like, 2008 versus 2023. In 2008, the leading up to 2008 was like the gold rush in real estate. It was purely speculation. People were rushing into housing with no qualification whatsoever because the lending guidelines allowed it.
Yeah.
So people owned multiple properties off stated income, stated assets, 100% financing. So what happens at 100% finance? You have nothing vested. You're going to lose. There's a 5% dip in that price. Well, I don't care. I'm losing it anyways. Whatever, let it go. That is completely different than the case now. Everybody put money down. There was no such thing as really 100% financing. Everybody had money in. Now they gained equity. Are those people going to just bail on that house? No, they're not. And to those people, that's a first-time home buyer, do they happen to own 7 homes? No, because there's no stated income program that allowed it.
Yeah.
So there's the, but wait. So let's just address that. Those people aren't going to fire sell their homes.
Yep.
Because there's nowhere else for them to go. Because there's a lack of inventory, lack of supply. Go look for, rental properties in Gilbert, Arizona, and guess what? There's, I don't even know. There's not very many.
Yep.
So there's that point right there that I don't see happening. So the next big thing, Gavin, is I hear people say, but I heard about Airbnb and the Airbnb numbers are down. Now, I think that there could be some validity to that, but I still think Airbnbs will pencil and these people won't fire sell. What do you think?
Well, I think they'll at least be able to make their payments, right? Like, I'm not fire selling something if it can pay for itself.
Yeah, most people bought an Airbnb in the last few years or refinanced it for sure.
And especially if on paper I have equity.
Yeah. I'd say 5% and it's a business.
Yeah.
You're using it as a business. You're renting it out. You just have to be a little bit smarter, but you could figure out how to make that thing pencil.
Yeah, 100%. Kind of to your point there, there's just a lot of buoying factors, right? Like if an event happened, if that put downward pressure on real estate pricing, there's a lot of just underlying support levels that would make it, not very advantageous for a person to walk away from a home, to let it go to foreclosure, to fire sell it, like whatever it was. There's just a lot of reasons why they wouldn't, just because of where rents have gone, just because of the mental struggle of letting equity disappear or evaporate. Like if people don't have to sell, they're not gonna. So
I think that's where you've got to differentiate crash versus drop in house value. And this is what was so interesting to me this year. So at the end of 2022, let's say last year, if you would have asked me this question, are home prices going to dip a little bit in 2023? I would have said yes.
yeah,
And in January and February, and I think even into March, I believe I was correct. There was a dip in house prices.
yeah,
But then all of a sudden something happened. And that script flipped. And all of a sudden house prices started to appreciate again. And you're like, holy cow, house prices are appreciating.
Yep.
And they've somehow managed to weather this storm, and it's due to the lack of inventory. Because I think what happened is you had all these people that said, well, shoot, let's see if I can't get top dollar. This is probably peak market right here. And they could have been right, obviously, depending on how you look at it.
Yeah.
And so they just threw their house up for sale just to see, and then nothing happened, and they pulled their house back off.
yeah.
But now we've seen appreciation. So what's going to happen in 2024? I mean, what the data would support is that the Fed is going to pause rates. They keep saying they're going to hike rates from here on out, but I believe that's just
It's hyperbole.
that's
they
hyper.
have to speak that
That's
way.
verbal candy,
Yeah.
and that's just so that the market doesn't have some big rally, because they know as soon as they say we're not hiking anymore, the stock market's going to go nuts, and they don't want that either, which I understand.
Yeah.
I think they're doing the right thing there, but it's frustrating, and I blame the Fed for all of this anyways. But I still think that in 2024, as we dip into a recession, rates are going to cool, mortgage bonds should come back down,
Yeah.
assuming there's no black swan event. And once rates get down, I say low sixes, we get into the fives, we start to return to a normal housing market, in my opinion.
Yeah, I would agree with that. And I don't know, though, like, if you couple lower rates with economic struggle, right? Like maybe a higher unemployment number, or maybe certain sectors just aren't thriving like they have. The loose policy with money goes away. If you can get rates, 5.5%, even like 6%, low sixes, people transact. People buy homes. You're going to have some sellers. You're going to have buyers. I think, we probably aren't going to see the kinds of appreciation that we saw, in years past, but I still think you're definitely going to have a good, solid market where people are transacting, and that loosens things up. That lets a person who needs that move-up home get that move-up home without feeling like they're absolutely screwing themselves, right, for leaving a 3% rate to go get 8%. So I definitely think you're right in that regard. I think next year can be a very good year, even with some economic struggle or recession, whatever it may be. But, it's something that the data keeps evolving. It's something we got to keep our eye on.
Yeah.
But I still am a very firm believer that now is going to be a great time to buy. And it could be the best time or last chance to buy.
Yeah. Well, it's just like we were listening to the head market strategist for Zillow, and nationwide, they're just looking at it. And you can see the concern. They don't know, but the inventory is a key level, and as long as that inventory stays low, and there's no portion of the demographic that is a distressed seller, and right now there's not even close to being a distressed seller.
Yeah.
And that's why I think it's really this game of financial chicken. You could the Fed could accomplish everything, and if they are careful with their unemployment, push unemployment up, say 1%, dip us into a recession, that allows rates to be able to cool back off down to this level we're talking about, low sixes, high fives. That's a lot of those people that lost their jobs are typically, those people are not your typical home buyers anyway. So I think that allows the relief, and then that'll pick up the activity. And that's why we kind of have this attitude of like, this might be one of your last chances, because if there's that little dip and rates come down, well, because of the lack of inventory, that's just going to cause house prices to continue their climb higher and make things unaffordable.
Or
as crazy
right,
as it is.
Right? Think if you're one of the unlucky people who lose your job. And you're in a sector, right? Like AI takes over your sector. It's like right now might have been your chance. This is the chance. And it's like, although it feels uncomfortable right now, I think people who are jumping in right now and putting up with what feels uncomfortable, a little bit higher payment, these higher rates, I think ultimately they're going to be happy they did. Yeah. And they're going to be happy that they got into the home ownership game. Down the line, there's going to be opportunities to refinance. But I think for those that just sit on the sidelines thinking they're going to be able to catch a falling dagger, as they say, or whatever they say, right? Mm-hmm. That you're just going to be able to get that drop in price and drop in rate and time it perfect. I just don't see that happening for very many people. Like, you know, it happens. People time it perfectly sometimes, but I just don't see it.
Yeah, and keep in mind the original reasons to buy houses back in the day. Anyways, you're not paying someone else's mortgage; you're paying yours. You're paying down, you know, the mortgage or on your own home, and the interest that you're paying, even if it's high, at 7%, 7.5%, it's fully tax deductible. Yeah. So it's like you still you gain all of those tax advantages, and the reasons why to own real estate are still there. And historically, we may have, you know, you could look back and be like, oh man, I bought a house in 2007 and it just was terrible. But if you like the home and you lived in there for 10 years, your house that you bought in 2007, come 2017, 18, like you were back in the money and everything was great. And then holy cow, if you lived there a few more years, you were way ahead. Yeah. So it's just the cycle. There is a cycle to everything. This could be the top, or this could be a little mini dip before the continue run up. We don't know, but right now the data says we're just in a little mini kind of a pause before another run up. That's what the data would suggest, I think.
Yeah, I'm in agreement. I'd say if Bitcoin can be $1 million, your 1,500 square foot house in Ahwatukee can be $1 million.
So, buy hard assets.
Buy
gold,
assets. Yep.
Real estate, Bitcoin. Boats don't qualify. Sorry.
Tell you what, when we're in the middle of a recession, I'll buy yours.
Yeah. Now that will drop in value.
So, well, cool. Well, I think that was some good information. I still am very optimistic about real estate. And if you don't own a home, I still think we got to figure out a way for you to do so. That's where we're at. I think regardless of whatever this crash people are talking about might happen, I still think that there's this asymmetrical risk profile, right? There's just way more upside than there is potential downside. And take the emotion out of it and look at it logically, and I think, you know, you can't really refute it. Like, buying a home is going to be the best thing you could do for yourself and your family and all of it. So
cool.
Thanks you guys.
Thanks for tuning in.
Bye.
See ya.